Hello everyone, welcome to Edupedia World. I am C. Radhika Singhal. In the last class, we discussed how to compute cost of debt, cost of preference share, and few of the models to compute cost of equity. For cost of equity, we divided into two ways, like if the shareholders are not expecting any growth, and the second, if the shareholders are expecting some growth. So in the second one, where the shareholders are expecting growth, we discussed regarding dividend growth model, where the shareholder expects growth in both dividend as well as in the market price of the share. In all the examples that I discussed in the last class, we discussed regarding where I have already mentioned that what is the growth rate. What if the growth rate is not mentioned? Can you compute that? Let's say, this is the example I have given you. For these 3 years, the earning per share of the company is 20, 22 and 24.2. Can you determine the growth rate, that at what growth rate the company is running? Very simple. 2013, the EPS is 20 and 2014, the EPS is 22. So you can simply reduce 22 from 20 and divide it by 20, you get a growth rate. So in this case, you can easily compute that the growth rate is 10%. Now let's take one more example. I've given you data from 2001 to 2006 and the DPS, that is dividend per share, 10, 11, 12.1, 13.31, 14.64 and so on. Now what if, in this case you can easily calculate that the growth rate is 10%. But what if I'm not giving this or providing the data from 2002 to 2005? I've just given you the data highlighted in orange color. That is, in 2001, the dividend per share is 10, and in 2006, the dividend rate is 16.105. Now, can you determine the growth rate? The growth rate is stagnant for every year, it's constant. See how you are doing it. If you want to compute 2002 DPS, what do you do? From 2002 DPS, you will say that it is 1 plus G, that is 2002 DPS. 2002 dividend per share is equals to multiply by the 1 plus growth rate is equal to 2003 DPS. That's how we computed dividend 1 from dividend 0. Remember, to compute the cost of equity from dividend growth model. Likewise, for 2005 DPS into 1 plus growth rate, that will be 2006 DPS. So if I have to compute, I just have 2001 DPS and I have 2006 DPS. So if I multiply 5 times, the difference between 2006 to 1 is 5 years. So if I multiply 1 plus growth by 5 times 2001 DPS, I can get 2006 DPS. Mathematically, if you see the above 3 rows, that's what we did. So 2001 DPS is 10 rupees, 2006 DPS is 6.11. You have to determine the growth rate. So 1 plus G to the power 5 will be 16.11 divided by 10. So you get to know that 1 plus G to the power 5 is 1.611. See, in this case, it could also be said that what does this G represent? So the G represents, if I say the G represents like how much is the present value of 1 rupee for 5 years. 5 is the N here. So that means N years at R percent. So 1 rupee at 5%. Sorry, 5 means not what are the R percent is there. So when you use that table, there are various tables given. When we use that particular table, we will find that G is equal to 10%. Perfect. Now this is using tables. You know, we can even calculate this thing on calculator. Well, this will be a little jugadu tarika to compute it. From this, whatever the calculator steps that I'm mentioning you, all this will give you a approximate figure. This will never give you to the point figure. However, in case you are unable to sort it out at which table to be used, how to solve it, you can use the calculator and solve this equation. How? So there are certain steps to compute it. You have to underroot the value. So in this case, the value is 1.611. So whatever the value is there in the bracket, you have to press underroot it 12 times. There is no logic behind these steps. Don't ask me that what is the logic behind these calculator steps. However, this is just a jugadu way to find the value. So what you have to do, you have to just underroot that value 12 times. Whatever the result is there, minus 1, and then divide it with the power. So in our case it is 1 by 5. So the power will be 5 here. Whatever the denominator power is there, divide that value by 1 by nth power. After dividing, whatever the result is, add 1 in that. Now whatever you get, press multiply equal to one time, multiply equal to second time. Do this for 12 times and you will get the figure of 1 plus g. So 1 plus g, you will get the figure. Reduce minus 1, you will get the growth rate. I'll explain you how to do it. You all know that 8 is equals to 2 to the power 3. So we can say that 8 to the power 1 by 3 is equals to 2. Perfect. So from now we'll compute this 2 through 8 1 by 3 on calculator. Do all these steps that I just told you. Type 8 on your calculator. Pause your screen, bring your calculator and do it along with me. So I'm going on the last slide again, on the previous slide again. Underroot the value 8 times. So you have already pressed 8 on the calculator. Now press the underroot button 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Fine. You all get a result of 1.005 on your calculator. Everyone? Now just press minus 1. So if you minus 1, you will get a figure of 0.00050. After that, divide by the 1 by n power. So 1 is already there, by n power. So here the power is 3 in this case, so divide it by 3. You'll get 0.000169 plus 1, that is the step 4. So if you add 1, the result on your screen is 1.000169. Now press the multiply button and equal to button. This is one time. Again press multiply equal to 2 times. Multiply equal to 3 times. Do this for 12 times. Your answer will be 2. So likewise do it for figure 1.611 to the power 1 by 5. You'll get a value that G is equal to 10%. Okay, so this is not, I do not know what exactly is the logic for all these calculator steps. This is only, you can say, a helper for you, that in case you are not able to identify which table to be used, you don't know how to apply logs, because that could even be solved using logs. You forgot that how to use log. You can do this, all these things with a calculator. At least you will get the approximate figure. So this is how all about dividend growth model. Now there is one more model to compute cost of equity, that is CAPM. CAPM is a very famous model and a very useful model, and it's generally used to compute the cost of equity. CAPM stands for Capital Asset Pricing Model. This model was developed by William Sharpe, John Mawson and John Lenter. And even for developing this model, William Sharpe got a contribution award, a Nobel Award of Economics in 1990 for this particular contribution, that is for suggesting this model. So this model, CAPM model, is basically on a funda, that is on the overall of FM funda. Higher the risk, high return. So the investor who is investing in the more riskier asset, in the more riskier security, his expectation will definitely be higher. right? CAPM is all about that. So CAPM actually builds a relationship in order to compute the cost of equity. It predicts the relationship between your risk and your expected return. So as per CAPM, every asset has a different degree of risk. Sounds obvious. Every equity they invest, there is no same risk for every asset. Some are more riskier, some are less risky. So this model is based on the degree of risk. So your KV will increase as the risk increases. So the cost of equity is computed in the CAPM approach. It actually divides the risk in two parts. One is risk free and the other is the premium for taking that risk. What is risk free? For example, you have rupees 1 lakh. What is the minimum return that you can earn? Riskless, you do not have any risk. Without any risk, how much is the minimum return that you can earn? Have you heard of treasury bills? Treasury bills are the risk-free assets. They are issued by the RBI and they do not have any risk in issuing that. So if you are buying T-bills, the return that you are earning, they do not have any risk. If it is expected that you will earn 8% interest, so you will earn. There is no risk behind it. There is no fluctuation that instead of 8 you will earn 7 or instead of 8 you will earn 9. So there is no fluctuation in the return. So risk-free rate of return is the return that we get on the treasury bills. So if you invest 1 lakh, how much return that you can get by investing that 1 lakh rupees in the treasury bill is the risk-free return. So if you are investing in some other asset which is more riskier, like for 100 rupees in T-bills you are getting 8 rupees. By investing in some asset, that 8 rupees could either increase to 10 rupees or could either reduce to 6 rupees. So there is some risk. So obviously your expectation is higher on that particular asset. So CAPM approach, what that is the logic of that cost of equity and the CAPM approach is that the investors expect a return more than the risk free. Obviously, why you're going to invest in that if you're earning only rupees 8 by investing into that asset? What you will do? You will invest in the treasury bills. Why you're going to invest in that asset which has a fluctuation return? So if you're taking risk, your cost of equity, your expectation is higher. So in this model, the CAPM model, it just categorizes the risk. It categorizes the risk in two ways. One is systematic risk, other is unsystematic risk. Let's discuss both the risk one by one. So first, what is systematic risk? Systematic risk is basically the market related risk. For example, the stock index has a movement of 10%. You're one of the stock in that in which you have invested. Because of that movement of 10%, there is some movement in your asset also, in the equity that where you have invested, right? So basically systematic risk evaluates the sensitivity that because of the movement or because of the deviation in that stock index, how much deviation is there in your own asset. This is termed as systematic risk. So systematic risk is the market related risk. Getting my point? For example, you have invested in stock A, your friend has invested in stock B. If the stock market has taken an upward movement of plus 5%, whether stock and stock B will move in the same direction, or it's like the stock A will also rise by 5%, stock B? No. The sensitivity for stock A and stock B will be different. So each capital asset or you can stock moves or changes at a different degree of movement. Systematic risk is for the whole industry. So there are various factors which actually affect systematic risk. For example, there is a change in interest rate. So change in interest rate is not under your control. You cannot actually deviate that factor. So that effect is there, but it's not only on stock A, that will be on stock B, stock C, stock D, stock E. So systematic risk is the risk which is caused due to factors like change in inflation rate, interest rate, which affects the overall market and not only your asset. It is not under your control and you cannot even diversify that risk. So the risk, this is measured, there is a statistical way to measure that risk, and that is called as beta coefficient. The risk is called as beta coefficient. So you can say that higher the risk, or you can say higher the beta, high is the required rate of return. Same thing, more risk, more return. What is risk? It is computed by beta coefficient. So beta coefficient, the more it is higher, the more it is riskier, the more is the expectation of the shareholder from you, more is the cost of equity. Beta coefficient is always computed in times. So if you say that your stock A is 0 times, that means it's a risk-free asset. So for market it is 1. And let's say if I say that beta is equals to 2, what does that mean? See, if there's a movement of 1% in the market, the movement in your stock, in your asset, will be 2%. So beta is equal to 2 represents that there is a twice risk, or twice is the movement of your asset as compared to the market. This is what beta is. So the CAPM theory is like higher the systematic risk, higher the desired, required rate of return. Okay. And the other risk is unsystematic risk. So systematic risk is the one which cannot be diversified because it's the market related risk. Everybody get affected by it. However, the degree of the effectiveness depends. The sensitivity depends. So that shows how much riskier it is. Vice versa is unsystematic risk. Unsystematic risk is a risk for the particular industry, for the particular company. For example, for a company there's a fire. Whether that will affect the other industry also in the same market? No, that will only affect your asset. If there is a dispute in the management of the company, so this will affect only your company and not the whole market. So systematic risk is for the whole market and unsystematic is a company specific risk. This risk, obviously, that your systematic risk cannot be diversified. If there is a change in interest rate, you cannot control that, you cannot diversify that because every stock is affected by it, the whole market is affected by it. However, this risk can be actually reduced by how to diversification. So CAPM actually, it's bifurcating two components for computing cost of equity. One is risk-free return because that is the least that you expect from that particular asset, plus a premium. Like I am expecting at least 8% because that is what I am getting by investing into treasury bills, plus an additional because I am taking risk. So to compute cost of equity as per CAPM model, what we will do, we'll add the risk-free rate of return because that is the minimum, and we add whatever the return that we are getting into the market less the risk-free rate of return, and we multiply that premium amount with the beta, that is with the risk. So if the beta is higher, let's say the beta is 2 times, the cost of equity will increase. If the beta is lower, less in the market, the premium amount will be less and less will be your cost of equity. So CAPM is equals to, as per CAPM, the cost of equity is equals to risk-free asset plus beta multiplied by risk premium. The difference between the expected return from the market and the risk-free asset is called as market premium. So we multiply that premium amount with the beta and add your return that we are getting from the risk-free asset. This will be cost of equity. Let's do one example. The market is giving a return of 18%. So this is the market return. The risk-free return is 11%. So how you compute the premium? You're getting from market 18%. Your risk-free return is 11. So premium amount is 7%. Out of the 7%, you will see that how much your asset has a sensitivity towards market. What return would you expect from an investment having a beta factor of 0.9? So beta factor of 0.9 represents that if the market is moving by 1, your asset is only has a movement of 0.9. So the expectation that you are getting, or the earning that you are getting from the market, 18%, you will multiply by the premium, that is 7% by 0.9, and obviously you are expecting the risk-free return. So 11% plus 0.9 with a difference of 18% and 11%. So the cost of equity is 17.3%. Clear? Now, beta factor of an investment. Now you have to compute the beta factor to yield a return of 21.6%. So here they have already mentioned that this is the cost of equity. You have to compute the beta. So K is equals to risk-free return plus beta into risk premium. So when you substitute the values, you will find that beta is equals to 1.514. What does this represent? That your asset is more riskier than the market. Market beta is 1 and your asset beta is 1.514. Okay, how we actually compute this beta? So beta of capital asset is equal to standard deviation of capital asset divided by the standard deviation of the market, multiply that with the correlation of capital asset in market. Something like class 11th, 12th, statistics, mathematics, standard deviation, correlation. I'm just giving you a brief because we are going to discuss in detail in portfolio chapter. I'm just giving you a brief what exactly standard deviation is and correlation is. So standard deviation shows the variation from a mean figure. So you have 5 figures, and if your mean is something 5, so how much is the deviation from your first value with the mean, your second value with the mean? So we compute that what exactly is the standard deviation of capital asset. Similarly, we compute the standard deviation of market. And correlation coefficient of capital asset and market shows what exactly is the movement. So if the market is going up, if your capital asset is also rising, so that shows a positive correlation. If your market is going down and your capital asset is rising, that shows a negative correlation. Plus 1 signifies that, so plus 1 correlation, what does that signify? It will signify that if your market is moving by 100 points, your asset will also accordingly move by the same points. And minus 1 in the opposite direction. So this is how we compute the beta of capital assets. I think something strike you regarding the capital asset and standard deviation. So I have given all the figures here, and we will just do an example to compute that beta figure. The risk-free rate of return is 8%, expected return is 18%. Now instead of beta, they have given you 3 figures. Standard deviation of an asset is 2.8, market standard deviation is 2.3, and correlation coefficient of asset and market is 0.8. So what we'll do? Beta of capital asset is equal to standard deviation of capital asset divided by standard deviation of market, multiply the correlation coefficient of capital assets and market. So beta is equal to 2.8 into 0.08 divided by 2.3%. I already told you beta is in times. So beta here is 0.97 times. So as per CAPM, each business asset has its own beta. So what if that particular company has different sectors, like a one sector, an automobile sector, same company has a telecommunication sector. So how will you determine that what is the beta for the whole company? Obviously I'm not going to determine what is the beta for the individual sectors. For that, we actually do a weighted average, the weighted average of the beta of all the business. And for weighted average, we take the equity investment as weights. I think this is well explained through an example. You will get what actually I am saying. For example, there is a company XYZ. They have two business A and business B. In business A, they have made an investment of rupees 300 crore, and in business B, they have an investment of 200. So they have a total investment of 500. The risk in business A, that is beta, is 1.5, and that in B is 1.1. So to compute the beta of the company as a whole, so for 300 crores you have a risk of 1.5. This 300 is for a total is out of the total investment of 500. Remember weighted average. So this is how we compute the weighted average. The total weight is 500 for that equity investment. So for 300 they have a risk of 1.5. For 200 they have a risk of 1.1. And this is the beta of the company will be 1.34. Okay, in this case the company has its own beta. But what if the company is a new startup? The company has just started. The company do not have any prior experience. You cannot compute the beta in that case. In such cases, company, what they do that whosoever are the existing players in the market in the same industry, we take their beta as a proxy beta and we compute the required rate of return. This is how CAPM model works. Thank you. That's all for today. Keep smiling.